How many times have you been in this situation? You go into the markets, you identify your uptrend, you're seeing your higher highs, higher lows, and higher highs. You then say, oh, here's my order block, or you fib it up and you want to buy off one of your key zones. You're putting in your entry, putting in your stop loss, you've got your target, it's looking good. And all of a sudden you're hitting stop loss. So you're like, cool, it's okay. You know, it's just one loss. Right, let me take a next trade. You've got your breaker structure. You're like, okay, now we can sell the market. It's just confirmed a downtrend. You come in, put your limit order, right? You got your target. You think it's all going to be peaches and cream. And then guess what? Boom, you get liquidated again. You see, if this keeps happening to you, you need to stop trading highs and lows. It's a common fact that over 95% of traders lose, right? And this isn't my opinion. If you look at brokerage statements, you can see that majority of traders and investors lose most of their money. One reason for this is that they all trade the same way. So if you're all trading the same way, you're all going to get the same results. And most people, again, we're taught that, you know, you find your higher highs, your higher lows, you wait for the magical pullback and you take your trade. But if that's how everyone's trading, why is everyone losing? What you need to start doing is looking beyond how most people trade. Observe the masses and do the opposite. Instead of trading highs and lows, look for what the highs and lows actually create within the market. Now, according to Citibank, on Euro USD, it costs over $1 billion to move this market by 1 pip. So for example, if we review one of those losses earlier, and we've got this higher high, higher low, and higher high, and we see that how many pips was inside of this movement, I mean, we've got about, what, 43 to the upside, right? And obviously, you know, all the little fluctuations inside, you know, there's a little bit of money that's spent in there. But if we compare that to a Wyckoff schematic, where the highs and lows come in and actually create what we call an accumulation or a distribution, we'll find that there's way more evidence of buyers in the zone. When we're looking at buying, right, we're looking for these Wyckoff accumulations, which you can see on screen, or these Wyckoff reaccumulations here. I know it looks a little bit confusing, but in simple terms, all an accumulation is when the market comes in, manipulates these lows, breaks to the upside. Or in a reaccumulation where it comes up, manipulates those lows and then breaks to the upside. What you'll start to find is when you trade these zones where the highs and lows create larger schematics, you'll find that number one, your win rate skyrockets. And number two, the trades you're going to catch are not just little pipsqueak moves. You're going to catch bangers that are moving hundreds or even thousands of pips. For example, right, when we look back here, this is just a single high and a low. This is a liquidity, right? Liquidity just means money where other traders are resting their orders. So if everyone's trading highs and lows, everyone's got their stop losses placed below this low, and the market will seek these liquidities like a magnet. That's why all these highs and lows keep getting manipulated and you keep losing your trades, because you are the liquidity. Identify these highs and lows, creating these schematics like you can see on screen, and then trade the retest, or what we call the mitigation of these schematics, to increase that win rate. So here, for example, reaccumulations are manipulations of lows, followed by breaks to the upside. So I would need to see it print this reaccumulation here, or it come up, right, manipulate those lows, and then break to the upside to buy it here. So the market starts to do what? It comes up, it's printing these highs and lows, it manipulates all these lows. Everyone who was buying loses, people get induced and get sucked into the short side and want to sell it. Then what happens? All of those sellers ultimately lose as well. So now both sides of the market have been wiped out. They've taken their liquidity, and now the real move will occur. But if you were trading Wyckoff instead of these highs and lows, like all these YouTube gurus tell you to do, well, yeah, you'd be losing. But when you start to trade Wyckoff, you're now trading in alignment with the real smart money. And again, Wyckoff is not just some hocus pocus strategy. This is actually a strategy that's been, one, backed by data over hundreds of years. And two, it is a study of how the bigger players actually fulfill their orders over time. Which, again, we've done videos on this in the Wyckoff Bootcamp. If you haven't seen it, go to the channel and check that out now. But once we can see these highs and lows, right, actually creating a reaccumulation, and again, we're focusing on the bigger picture here. We're zooming out and not just getting sucked into the intricate movements. We can see it creates what? That reaccumulation where it's come in, it's manipulated the lows and broke to the upside. So what I want to see it do now is the market to come in and retest this and then provide me a lower time frame accumulation. Now, again, we're not going to worry too much about these entries now, because again, I've done so many videos and case studies on this before. But how convenient is it that the market now comes back, retests this, and now goes for hundreds of pips? Now, in terms of actually entering on this position, there was a few entries the market provided. Now, for me, look, I don't just take random retest entries. What I like to do is build confluence and go into the lower time frame and get refined entries to increase the risk to reward and increase my win rate. The reason why it increases the risk to reward is because I'm taking an entry maybe with a few pip stop loss, but having hourly and higher time frame targets. And it increases the win rate because I'm going down and looking for buyers and proof that buyers are actually at my buy zone, rather than just saying, oh, buyers live at this zone, so let me just randomly buy it. I'm letting the market prove itself to me and show me the intention, because the market will always tell you and show you the moves it's going to make. You just have to listen and tune into the markets and not assert your own will onto it. Because if you're going into the market and trying to say, oh, it has to do this, well, that's not going to work. Let the market show you the moves, right? Create your if-then scenarios. If the market manipulates these lows, then breaks to the upside, you'll get in on the mitigation. So you can see it comes in, manipulates the lows, breaks to the upside, and comes back for its mitigation retest. What we'll then do is go to a lower time frame, and we'll now try and enter based on a lower time frame accumulation or a lower time frame reaccumulation. So we can see as it comes into our demand zone to the left, it doesn't really print anything that's worth taking here. But what it does start to do is build another reaccumulation. And again, just see what they're doing here with the highs and the lows, right? You see how the highs and lows of the market are creating something bigger here, where these highs and lows are creating those manipulations of the lows, followed by that break to the upside, right? So we're letting them create a schematic. And then what we can do is come in, we can fib the manipulation, right? And then build confluence at these 50%. Because if we see here at this 50%, what are the highs and lows doing? Again, pay attention. The highs and lows are doing what? They're manipulating the lows, followed by a break into the upside. And now after that manipulation has occurred, now I can get in for my trades. So we've got confluence with the 50 of the whole thing. We measure out our manipulation, and we can see, oh, how convenient. The 50% is lining up with the 80%. So we can come in, we can take that entry off the 50% of the whole thing, because the confluence, stop loss below this low. Now here's a difference. This is not just a single low. This is the low of a schematic where so much effort has gone into it. And that's the difference between trading Wyckoff and trading highs and lows. Because a single low or a single high, there's not a lot of money that was gone into the creation or manifestation of that. Versus this schematic, price spent time, effort, energy, and money to actually create this schematic versus just a single low. And once you've identified the manipulation and you're trading the mitigation of that, you can now get the most precise entries. Instead of being that guy who's just been manipulated and now losing and crying about it, you'll be the guy who's getting in after the manipulation has occurred. And now instead of crying that you've lost money, you'll be laughing to the bank. And then what we can do to increase that risk to reward is just zoom out and target the new high. Now again, we use highs and lows as targets, not as entry confirmations, because there's no effort or energy that's behind that, because highs and lows are levels of liquidity in the market. And if you want a video on liquidity, go down to the comment section, write the word liquidity, and I'll create a whole new video and a masterclass on everything you need to know about liquidity, when it has to get manipulated and when it doesn't have to get manipulated. And then we can target our higher time frame zones and just wait for the market to do its thing. If you did enjoy today's video, go down to the comments, let me know one thing you liked, one thing you learned, and one thing you want to see in the next video. With that being said, I'm going to see you all at the top, from the top, because you already know, man, that bottom is way too crowded. Sheesh.